Most of us are born with an abundance of time, yet we spend the vast majority of it trading our unrecoverable hours just to survive. We clock in, do the work, and collect a paycheck, accepting this exchange as a normal fact of life. That paycheck immediately goes toward basic necessities. The money flows straight out of our bank accounts to cover rent, groceries, and electricity. Because we can choose where to live or what to eat, we feel like we're in control. But by the end of the month, the account is nearly empty, ensuring we have to go back to work the next week just to keep the lights on. Escaping this cycle comes down to a simple dividing line: ownership. If you don't own assets that produce value, you are the asset that someone else owns. Earning a high salary doesn't actually solve this problem. It usually just scales up the cost of survival. Breaking the dependency requires leveraging a specific mathematical concept that wealthy individuals use to generate income independently of their own labor. To see how this math works in practice, we have to look at this chart tracking two different financial timelines. Person A starts putting away $200 a month at age 20. Person B waits 10 years until they are 30, but tries to catch up by investing $300 a month instead. The money they invest earns a percentage of interest, and that interest gets added back to the pile. Soon, those initial dollars duplicate themselves into clones, and those clones start generating their own interest, creating a self-replicating loop of cash. Because Person A's clones had a 10-year head start to multiply, their total skyrockets in the final decades. Even though Person B invested $12,000 more out of pocket over their lifetime, Person A finishes with nearly $600,000 more, ending up with over $1.2 million. Those final decades of explosive growth happen only if you allow enough years to compound. Delaying the start date robs the clones of the cycles they need to multiply. A smaller amount of money invested consistently over a long period will beat a larger sum invested late. Time itself is the primary engine of wealth. But as income grows, people face intense societal pressure to upgrade their lifestyle with expensive cars and designer clothes. When you spend every extra dollar on luxury items to impress other people, you take money away from your future self. Every dollar spent on an overpriced watch is a dollar that can no longer clone itself and generate interest. Those who successfully build wealth tend to ignore these status symbols. They take their excess cash and route it straight back into their investments, knowing that a steady, growing portfolio is far more valuable than the fleeting approval of strangers. Buying things you don't need effectively kills your interest clones. It drains your capital, resets your progress, and forces you back into the cycle of trading your hours for a paycheck. This diagram shows how you can automate this entire process using an index fund. A single monthly contribution gets automatically divided into hundreds of tiny slices, purchasing fractions of the largest companies in the market without you having to pick individual winners. Because it's entirely hands-off, the portfolio simply sits in the background. The businesses in the fund operate, generate profits, and increase your balance while you sleep. Eventually, the compounding interest reaches a critical mass. The yield generated by your investments outpaces your monthly expenses for rent, food, and utilities. At that exact point, you no longer need to trade your finite hours for a paycheck. Your living expenses are fully covered by the output of your assets. The purpose of building this financial engine isn't to buy a mansion or a private jet. It is to purchase total control over your own choices. When your money pays for your survival, the system can no longer dictate how you spend your life. You wake up every morning with the undisputed right to do whatever you want.